Welcome this morning. Well, it could be afternoon, depending on where you're joining it from. I can see everybody coming in the room as everybody's like starting to join the session and so on. So firstly, let me thank you for being here as well. My name is Sam Evans, and I working with. Hi Tate, how you doing? I'm getting all your questions coming through. So any comments you've got are going to pick up in. I will be able to pick up. I'm sharing my screen with you, so yeah, type in your questions as we go here as well. Good morning anyway, officially. It's just 2 minutes after 10. I'm on the East Coast of the US, Philadelphia area. It's 3 p.m. if you're going to be joining us from London, 4 p.m. Central Europe. Thanks for having me here. Got 45 minutes with you. My name's Sam Evans. I'm one of the senior instructors with Online Trading Academy. Had the pleasure of doing a number of FX Street webinars in the past with you guys, and maybe you've joined me from the past, or if you're brand new to Online Trading Academy or FX Street, welcome. So I don't want to kind of waste any much time. I want to give time for questions as well and look at some charts. 45 minutes isn't a ton of time, so I wanted to kind of give a little bit of a snapshot of the methodology that we use to trade and invest in the Forex market. I'm in a strong position that I co-developed a lot of the strategy, the patented core strategy that we use in Online Trading Academy. And I thought it might be neat to introduce you to some of those concepts, look at why some people are struggling, and give you a little bit of an idea of the methodology. There are further webinars as well that are coming up with FX Street. We're going to be doing this on a monthly basis. So my goal is over the coming months to expand more and more, to give you more of an idea about what we do at the Academy and show you how you can stay in touch as well. Does that sound good to everybody? So rather than trying to cram too much in, let's go piece by piece, get some time for questions on here. And also we could look at some live markets at the end as well for about, maybe 10 minutes or so, or even longer. It depends how quickly I can get through everything and see obviously what we can do from there. So using price action to find trading opportunities. That's the title of this. And when I was coming up with this, I was thinking to myself, how many people actually know what the definition of price action is? And how can we explain it? In the 16 years that I've been trading myself and I've been working in the markets, I've worked with hedge funds, I've worked with proprietary trading floors. I've had the most enjoyment literally working with myself and teaching for almost 12 years now. I find that, really there are clearly two very distinct groups of participants in the marketplace. And we've got the group who pretty much struggle the most. The reality being the people who struggle the most here are the retail Forex traders. And I include myself in that list of retail Forex traders. It can be, very challenging for a retail Forex trader to consistently make money in the marketplace. Not because I don't think they've got the ability to, guys. More so, I believe, just because of the information that's out there. And at Online Trading Academy, we like to really focus on what do the institutions do? What is their game plan? How do they like to participate in the market? And I think for most people, the reason they struggle in the Forex market is everybody's using the same information. Does that make sense? Everybody's reading the same stories. Everybody's looking at the same news. Everybody uses support and resistance. Everybody uses moving averages. And maybe you're brand new to the world of Forex trading. Maybe you're not, but there's a lot of information out there. What I want, and people end up using retail tools. And I put on here, retail traders using retail tools here. And when I talk about retail users, I'm talking about conventional technical analysis. Take, for example, chart patterns. There's so many different names of chart patterns. Candlesticks themselves as well. And I was fortunate enough to be trained by people who actually worked in Wall Street, people who worked in the Chicago Mercantile Exchange. And I talked to these guys. I said, did you use a lot of these tools when you were trading money in the funds, in the firms? Did you use this when you were trading in the exchanges? And they were like, no, we use pure price action. I'm like, what is price action? And very simply put, institutions and banks that price action trading, price action investing are literally buying low, selling high. That's really what it is. And I'm going to, over the course of these webinars, try to get us into this point here where it says change your mindset to think like the banks. And, at the end of the day, think about this. Do you really think that a Goldman Sachs in this world is going to be waiting for moving average crossovers and using regular support and resistance just like everybody else? One of the big complaints I get from a lot of people is, Sam, I feel like my stop losses are constantly being hit. Whenever I'm setting up trades, I put trades on, stop losses get hit, and then guess what? The market then moves in my favor after the stop loss being hit. And I'm like, yeah, I know what that can be like. But again, think about it. Do you really think the big traders in Wall Street, the big traders in London, the big traders in Germany, do you think they're all using the same, reading the same books and using the same analysis? No, they're not. So we have to kind of go one step beyond this. And what we like to do at the Academy is focus on the most simple processes of trading. Now, guys, 16 years in, I learned one thing. Markets can only go up, markets can only go down, and markets can pretty much stay sideways. You know, you're either going to get it right when you buy, you're going to get it wrong. There's not really a lot else to do. And none of this is really about trying to be fancy. It's trying to be logical. And what I would like to do here is I'd really like to come at you from a point of logic, okay? I want you to think about basically how any business in the world makes money, okay? Buy low, sell high. Maybe it's, you know, Tesco, Sainsbury's in the UK, Walmart, you know, in the US, Apple, any of these guys, motor car companies. What they're doing is they're buying products low with the intention of selling those products high. That's really it is. And this is where we get our profit margin. PM is my profit margin. The lower I buy, the higher I sell, the greater my potential profit. I like to lose this in terms, guys, and I'm going to just change the color of my, hopefully you can see it on here. Think about it in terms like this. Wholesale and retail. Wholesale, retail. That's what I'm looking at here. Wholesale versus retail. The lower I buy something, the more upside I've got. The higher I sell something, the more downside I've got. And when people trade currency, when institutions, banks, and all these big companies are trading currency, it's the same thing. If I've earned a lot of pounds and I need to convert those pounds into US dollars, I want to sell those pounds at the highest possible price when they're strong. I want to buy those dollars at the lowest possible price when they're weak, because it's when markets are weak they have the greatest chance of rallying. When they're high, they have the greatest chance of falling. Where a lot of people get hurt is the price action in between. Because I love, well, from you know, a major retail company, they're no different from a Whole Foods. They're no different from any other company that makes money. They want to acquire an asset cheap. Okay, we want to acquire an asset cheap, and we want to sell that asset as expensive as possible. Guys, does that make sense to everybody? Acquire something as cheap as possible and get those assets as, sell those assets as high as possible. Can everybody hear me okay, by the way? I just want to check. Can I just get a yes or no just in the chat box there, just to make sure, because I just got a little network connection pop up there. Perfect. I just want to make sure I'm not using. Thank you, guys. I appreciate it. Just so I know that you guys are there, which is good. So whatever way we want to look at it, institutions control the market. Why do institutions control the market? Why is it that institutions manage to move the price of our investments? Because they trade much size. Has anybody here in the room ever been able to move the Forex market with their enough to move the right? If we could move the market ourselves, we would be the big fish. We would we wouldn't need to be, you know, we would be controlling the market. We would be an institution ourselves. Institutions do mud the market because they create massive levels of demand. Okay, what were you trading then? A penny stock? What were you trading, by the way, to move the market yourself? And how much did it actually move, by the way? Because I need to talk to you if that's the case. We need to hook up, right? Institutions, okay, have the bulk of the money in the marketplace, okay, and they can't get all their orders filled at one time. I want you to think about it like this, okay? Let's go over to do a paint, right? Do a box paint. Imagine a desk, okay, with a stack of orders on it. Buy orders, okay, ton of buy orders on one side, and a stack of sell orders on the other side. If we've basically got two stacks of buy and sell orders, we've got buy orders, these represent demand, these represent supply. You've probably heard of terms of demand versus supply. If demand and supply is equal, prices will go sideways. However, if demand is greater than supply, prices are going to go up. However, if we have supply we go back on here and we have a case where we've got supply that is greater now than the demand, prices are going to go down. Okay. Now you think about it, this is short order flow. Literally orders coming into the system, create demand and supply. Institutional buy orders create demand, institutional sell orders create supply. That's pretty much how it works. So somebody with a bigger account, somebody with more money to play with is going to be able to create that demand, be able to create that supply in the market. And you've got to think about it. If you go and try, say, buy 10,000 units of euro dollar, 100,000 units, like standard lots, 100,000 standard lot, you could go and buy $1 million worth of currency. You could go and buy, $5 million worth of currency. You go and buy $100 million worth of currency, you're going to need somebody who's willing to sell you that currency. This is called the zero-sum game. A buyer needs a seller and a seller needs a buyer, right, guys? So with those two things in mind, you've got to think about it. Like if you used to keep it very simple in shares, it's very easy to buy 1,000 shares, not so easy to buy 1 million shares in one go. And we learned this in the institute from being in institutions myself. With an institute, when it comes to the institutions, you've got to scale into positions over time, requiring multiple transactions. You are not going to get filled, on 500 million, euros on a position at the click of a button necessarily. You're not going to get filled on 1 billion, pounds on a position straight away. You are going to get filled on 100,000 because the market's big enough to do that. And because our position size is small, this is us. Our positions are small. We can get in and out of the Forex market very, very quickly, which gives us an advantage. And what we can do is we can create right movements that are actually created by institutions themselves. Okay. So what we can do on this, okay, I don't know, Waladra. So can you have Arab subtitles on here? Did it say on this? If you like, the administrators might be able to help you with that. So the, excuse me, what our goal is to do is this. We're not trying to create moves in the Forex market. We are trying to recognize moves in the Forex market, and then we ride on the back of those moves that the institutions create, basically. And this is what our core strategy is all about. So, if we've got basically the scenario of, hey, you know what, the big boys control the market. They create massive levels of demand. They create massive levels of supply. Prices are going to go up. Prices are going to go down. We want to read those footprints. So if I go back over to my board here for just a second, okay, what I'd like you to imagine is this, the simple process is this, a zero-sum game, okay? So if this is a picture of what demand looks like, and this is a picture of what supply looks like, okay? Here are my orders to sell. Just imagine a group of orders on here, and these are my orders to buy. These buyers need these sellers. Buyers represent demand, sellers represent supply. If you've got equilibrium, like I said, price is going to stay where it is. However, if you've got more willing buyers, i.e. more buy orders, these sellers will sell to these buyers over here, and they will cancel out some of them, but we will still have residual orders left over. That means there is demand still, but zero supply. Prices have to go up at this particular point. And people forget about this. And because the banks institutions have such huge size that they can trade with, when they put those big orders in, they're going to create such major imbalances between the demand and supply that they're going to create big moves in the market. Because remember, every buyer needs a seller and every seller needs a buyer. So now, knowing this simple rule on here, what can we do with this? We can start to identify market turns and moves before they happen with a pretty high degree of accuracy, because we can start to recognize where these demand and supply imbalances are. Remember, I want to buy when institutions are buying. I want to sell when institutions are selling. And here's the other thing as well, guys. When you place a limit order in the market, you are specifying a price. You are saying, I want that price, and I want that price or better. If you cancel that order and put it in a later date, your order goes behind everybody else's. So when these big institutions are putting these orders in, they have to be accurate. They have to put their orders in ahead of time. And they're going to hold out for the best possible price. And they're not going to be able to just buy as much as they want in one go. They're going to have to accumulate over a period of time. this is going to create footprints for us, and these footprints that they create for us are going to create opportunities. Let me give you some of the key dynamics here. Let me just quickly read these out for you. I want to do a mini lesson, and then I want to go over to the charts. Okay, so this concept that we're talking about here, we know the big boys make money. We want to make money too. How can I find the lowest risk, highest reward opportunities? Well, our lowest risk, highest reward opportunities are always going to be near what I mark on here, turns in price. Near these turns in price. This means we need to be able to time these turns in price, and we want to be doing it with a pretty high degree of accuracy. Well, every market's going to turn at a level where supply and demand are out of balance. If you have equal demand and equal supply, prices are going to stay where they are. But if you have greater demand and very little supply, price will go up. If you have great supply, no demand, price will go down. And guys, you can see this on a chart if you know what you're looking for. And this is basically bringing this right back down to what we want to do. This is how money's really made and lost in the markets, because the markets consist of the buying and selling between these two groups. What we want to do is buy when these guys are buying. That's what we want to do. We want to be on this side of the trade over here, buying when the institutions are buying, because we know that they make money. We have to just be patient. And if you've got a notepad and pen next to you right now, guys, let me tell you this right now, right down at the top of that, patience. Patience is the most important part of this. The big institutions will wait for the best possible prices to accumulate. They will wait for the best possible prices to sell. We have to just do the same. We want to do what these guys do. Okay, great question on here. So let me just pull that question up that we've got. So from Michael, Sam, then why did price often go through the zones without filling any orders or following trend? Well, it has actually filled the orders. Okay, what's actually happened? That's a great question, Michael. So when a price goes through a zone, and we can look at some examples, it means all those orders that got filled. Okay, so when price is in a trend, it means that one side of the party is actually losing. Think about it in this respect. Not every institution wins. Okay, not every institution wins on every trade. If you look at Goldman Sachs, their success rate is about 40%. They have to do all that. They have to actually show their public records. Okay. So over the last 10 years or so, you know, their average success rate, if you look at their public records, is about 40%. They get it wrong. I'm not just saying because they put a good big order in, they're going to get it necessarily right. They're a big institution that's come in with a bigger side. So if you had a major area where they were buying and then a load of sellers come in and all their buy orders get filled, it means that a group of other institutions filled all those orders for them. So typically I found it when I was trained by the guys who worked in this, Michael, and everybody else, I used to ask the same question. Well, when do these institutions get all their orders filled? Typically when they're wrong. Do you understand? When they're wrong. So it means that there's a trend developing. That's exactly what it is. So when it goes through a zone, and also it might be that a zone has been tested many times because trends are part of this as well. So as these webinars that I'm going to do with you go on, guys, Michael, we're going to focus on a little bit of that actually, you know, when a zone fails. Because remember, in this business, nothing is set in stone. In fact, I would go as far as saying, while supply and demand is probably the most important thing from a strategic point of view, risk management is even more important than that as well. Okay, I hope that helps, buddy. Great question, by the way. Okay, so and then trends will develop, but you know what's typically you're going to find, guys, is when you see zones failing on one time frame, it means there's bigger forces at work, and there was a demand zone or a supply zone on a bigger time frame, which ties into our next question on here. And you can probably see the chat questions coming up. That's why I brought them up. From Gigi, do institutions usually analyze higher time frames such as the daily and weekly to enter their big trades? What a great question. The simple answer is this, and again, I can speak from having been in that world as well, and the answer is yes. Think about this analogy. Okay, let me go over to a whiteboard for you for just a second, and I hope this helps, you know, using the whiteboards to show you some of these things. So if I go back over here, and I think about it a little bit like this. This is the best way I look at it, is and by the way, please excuse me for my drawing, okay? I'm using a pen on here, a touch pen to do this. But, you know, if I'm literally standing there at the edge of the little pond and I'm fishing, yeah, I got my little fish in here, right? And I got my single line rod, okay? What can I do? I can catch one fish at a time because I've just got one fishing rod, right? That's all I can do. I can catch fish. I can go to this area. There's plenty of fish in there, but I'm only going to really catch one at a time, right? That's the retail world. For the institutional world, guess what they are? Now, there's the C, There's the waves in the sea, and there are literally hundreds, thousands of fish. And what are they doing? They're in a boat, okay, and they are casting a huge net over the boat. Does that make sense? That net is not catching one fish at a time. What's that net doing? What's that net doing, guys? Is that catching one fish at a time, or is that catching many fish at a time? Because they got a business out of it, right? This guy over here, he or she's not trying to create a business. These guys are a business. They have to go to the market, they have to go to where there's more fish, and they use tools to pick up more. Think about these bigger time frames. I'll have the areas where they can catch more fish. There aren't the amount of fish in the pond, and there's only a single line rod. So the higher time frames are going to be where those institutions have to get themselves the bigger chance. And you know what? We can be accurate. We could turn around and we could say, hey, you know what? We could be completely accurate on this. So we could say to ourselves, I don't know. Let's say, for example, on here, if we were going to be, let's just do this. Let's just select all and erase it. If we were going to basically go on here, be an institution on here and think about it from an institutional perspective, we simply, if we want to get more orders filled, we have to use a bigger map. We have to use a bigger area. So a lot of the higher time frame charts are going to give us some big footprints that we can use as well. The smaller time frames are going to allow us to be a little bit more accurate, because the thing you've got to understand is, as retail traders, we can't take on quite as much risk as those institutions can take on. So what the smaller time frames are going to do is just allow us a better way to get in for a lower cost, because you could have an area on a price, like let's say, for example, what's the euro trading at right now? Let's just go to the charts. Take a look. So let's pull up a chart of euro dollar. Love the questions, by the way, guys. This is great. I can look at a chart of the euro dollar right now. And we've got a key supply area right now that we can see the euro dollar was trading at. Okay, this area 115.76 to 116.22. You'll see this area here, guys. So we haven't quite tested this area again since it's been there. Well, that is a wider zone. So this price activity in here, don't think that these institutions are just trying to sell at one price during this area. They're trying to sell at multiple prices during this area. You can see where we've had price demand on the euro dollar. I was doing one of my live trading XLTs just a couple of weeks ago when the price was down at these lows here. We were starting to get ready to buy. This whole area between 12.91 and 12.16 is a whole area where there's institutions buying. We can go down and find a little more accurate entries, but they can afford to be a little bit wider. They're looking more for an average price. That's what we used to do. We'd have an area. We'd say, hey, we want to buy, this stock, for example, between 50 and 55. Give us an average price of 52.50. And we would accumulate as much as we could, because we know what we weren't in the institution. We weren't going to get everything at one particular price, because our orders are too big. As individual traders, we've got a higher probability of slipping under the radar and actually getting our specific price. Does that make sense, guys? So that's why the institutions have to trade on bigger size, guys. It's a very, very simple thing. So hopefully that helps a little bit. So what we're going to use is we're thinking like those guys. Look what we've just did. We're learning to think and act like institutions. It's pretty cool, right? That's what we're doing. We're not thinking like retail anymore. We don't want to think like this. We want to think like this. So this is one of the things I want, a concept that can be pretty alien to people, and I don't spend a lot of time on this. One of the issues that a lot of people have is this. There's so much information out there that we can follow. Excuse me. So much information that we can follow that it becomes, I call it the minefield. Now, one of the most ridiculous things I ever hear, when I'm reading about Forex is this. It's like, oh, the great thing about Forex is everybody gets the news at the same time. It keeps it fair. Come on, man. Keeps it fair? I mean, I think that's ridiculous. What, you're telling me that these big institutions don't have access to the information well ahead of most people? I'm sorry, guys. I don't believe that. And by the time, you get the news come out on a news-based service, it's too late anyway. The institutions have already made their mark. So, when it comes to all these earnings, news, GDP, non-farm payrolls, Fed announcements, there's so much information. Heck, most of it I don't even trust anyway. A lot of the time, we've seen in history that companies lie about certain information inflation. They massage, governments will massage GDP figures and inflation figures. Everybody today is going to be focused on FOMC day, on the euro, on the dollar because of interest rates. Are they going to hold at 2.5%? Are they going to go up? Who cares? There's people in Goldman Sachs who already know what those figures are going to be. They're already planting the seeds on their trades and getting ahead of the pack. That's why all we can do is trust what we see on the price and let price come to us. So it doesn't matter, because you're never going to know why a currency went up. You're never going to know why a currency is going to go down. All you need to know is this: where did it go up and where did it go down? I don't care why. The institutions are never going to tell you why they buy. The papers will always tell you why the market went up after it went up. The press will always tell you why the market went down after it went down. I need to know before that, and the only truth I can get is price. Price is the only leading indicator. That's why if I go over to my charts here for just a second, can you all see these charts, by the way? Can you all see these price charts on here? I just got a selection of different currencies on here, guys. That's why one of the things you're going to notice on all of these price charts that I'm showing you here, I don't have any technical indicators on here. All I have on here are just pure price charts, and that's all I need, just to see the footprints of the institutions, where they're buying and where they're selling. I mean, that is really it. That is as simple as it potentially gets. Okay, so again, keeping it simple, keeping it easy. Okay, question here: do fundamentals tend to follow daily technicals? I believe that personally, when it comes to fundamental analysis, there is weight in fundamental analysis. There's a lot of things that have been putting pressure, on the dollar. Obviously, the fundamentals, like Great Britain, for example. As you can probably tell, I'm from Great Britain. I'm actually London born and bred. I happen to live in the United States now, but I'm a big follower, obviously, of the pound, and I see all the things that are going on in Brexit right now. And there's fundamentals that are definitely shaping and bringing more volatility into it. But really, at the end of the day, the problem I have is there will always be fundamental analysis to justify why a market went up. There'll always be fundamentals to justify why a market went down. But the problem is fundamentals never tell you what's going to happen next. They justify more what's already happened. So in the very long term, yes, fundamentals can be useful, but they don't help you actually time an entry. That's the problem, Amir. They don't help you time an entry, and only price will help you time an entry in that respect. So, what we want to look at on here, I'm just a technical guy personally at the school. We are a technical school, and we focus on it. And guys, we don't even care about, anything more than, basic candle construction, because I don't care, what the name of a candle is. I don't care what the name of why a candle is. All I care about at the end of the day is, okay, what created a candle? And it's really, really simple. And I'm going to quickly whiz you through this example here. If you had, is indicate analyzed only in the daily time frame? No, the analysis can be done this on all time frames. All time frames. I will always say, in my humble experience, though, my humble opinion, the best, I would say, the better time frames are always going to be the better time frames, guys, are always going to be higher time frames, is a little bit more reliable. Where a lot of newer traders go wrong is they start on small to 5-minute charts and they get chopped to pieces. If you don't understand how the big charts work, you're certainly not going to understand how the longer chart, the small charts work. And in my webinar next month, we'll get more into this. Guys, I'm going to be doing these webinars like as a series of webinars, gradually walking you through some more of these concepts, okay? So we will get more into that as it stands. For now, let's just focus on some of the keys on here. And I want to whiz through this, okay, for about the next 5 minutes, and then I want to take a good 10 minutes just to whiz over to the charts and look at some levels that you guys can actually keep an eye on over the coming weeks until we get together again on our next session. Is that all right, guys? So let's just say we've got a market here trading at 41.30. And we've got basically 400 buyers and we've got 100 sellers. Before this market can either go up or down, transactions need to take place. And you'll see on here that these 100 sellers cancel out these 100 buyers, leaving 300 buyers still. See, the sellers need the buyers and the buyers need the sellers. So now we've got winning buyers, but we've got no sellers. So if you look at this as a picture of demand versus a picture of supply, the next candle you're going to get is always going to be a green candle, because these buyers simply didn't get all their orders filled and there was not enough supply to meet it. Demand's greater than supply. And the origin of change in price is where either the buyers or the sellers becomes zero at a specific point. That's it. I mean, that's really all it comes down to at the end of the day. So, you know, guys, when we're looking at this, right, you've got to understand, if there would have been, if we go back a slide on here, if there would have been literally, how many have we got here? 100 and another 300 sellers at this particular point. Those guys would have cancelled those guys out, and these guys would have cancelled these guys out, and we would have just got zero price action. Price would have stayed where it was. If we'd have had on here 800 sellers and 400 buyers, we would have got a downward candle. The fact is, at the end of the day, in this case, because of the imbalance that we had on here, because of this imbalance that we had on here, we have more demand than supply. Prices went up. And the thing is, this is what's key, guys. Who has enough money to create such a high amount of buying activity that it might not get completely filled? That's banks. That's banks. And if the banks were that keen to buy this much the first time around and only got, say, a quarter of their orders filled, that means if the price comes back to this same 41.30 price area in the future, there's a good chance that they're going to hit this area again, because that's all this is. It's all about unfilled orders at the end of the day. Institutions are businesses. The bulk of their buying is going to be at the lows. The bulk of their selling is going to be at the highs. Where most people go wrong is they spend their life trading somewhere here in the middle. They trade here in the middle, and they basically get chopped to pieces. If there's this many buyers at this particular area on here, then guess what? Think about a store. Any store wants to buy as much as it can when it's cheap and sell as much as it can when it's expensive. It's here in the middle where we get the chop to pieces. If you take this same concept and turn it on its side and take a look and think about how any other business in the world buys, they buy wholesale with the intention of doing what, guys? Selling at retail. Turn these orders on their side. Take a look at this little area here, and I'll get to that question in just a second. Where we can see this price, I want you to look at how prices took off like a rocket from this particular area. See how we were going sideways for a little bit on there? Sideways, sideways. The rally that came away from the market tells me two things. It tells me, number one, in this area in yellow, the first thing in this area in yellow, right here, and the fact that the price rallied from this point. Number one, it tells me that somebody was trying to buy a lot and they didn't get all their orders filled. How do I know that the people buying in this yellow area didn't get all their buy orders filled? Very simply, the price would have stayed where it was, because for all the buyers to have got all their orders filled, they would have needed equal sellers, right? So there weren't enough sellers to compete with the buyers. So not all the orders got filled. And secondly, who's got enough money to create an order so big that it might not get completely filled? A retail trader or a bank? Of course, we know the answer will always be the bank. So if the people were trying to buy a lot here, this means if the price comes back to this same area in the next time, okay, if the price comes back to this same area in the future, some of those orders from here are probably going to be still in this residual area for us to take along and to buy if the price comes back to it. So we're letting the institution create the area, and if the price comes back to the area, we jump in because we know there's likely unfilled orders there, and those institutions are going to do everything they can to buy at that particular point the next time it comes back down to that area. And in this instance here, this is where a lot of people get it wrong. We want to avoid trading here in the middle. We want to trade in areas of supply and areas of demand. The only reason the price dropped so hard from this area of supply is because there was a big stack of sell orders here and not enough buyers to get those orders filled. The only reason that the price rallied from this area here is because there was a big stack of buy orders and there not enough orders to get it filled. But what you understand is when it comes to news, and I will get to your questions in just a second, the market's always going to be high when there's great news, and the market's always going to be low when there's bad news, because the press have to justify why the market's high or why the market's low. But as you're going to see, when the news is at its very worst, which is when the market's low, that's the best time to be a buyer. When the news is really strong and the market's high, that's the best time to be a seller. And that's how we start to put all of this information together, guys. So if I just look at some of your questions for just a second, Michael's asking me, then should we keep an eye on the volume available as well? The problem with volume is this, guys. You can't believe any of the volume. Well, Forex generally, unless you're trading Forex futures, The issue that you've got is with Forex futures, you do have volume available. But the problem is what you're going to find is with most volume studies is, a lot of textbooks will say, well, buy after the volume comes in. Well, the problem is if you're buying after the volume comes in, you're buying after everybody has already bought. Do you understand? I want to be buying before everybody buys. I want to be in the trend before the trend takes off. I don't want to be the last one. I always say this, I don't want to be the last one to the party because all the good food's gone. I want to be there at the start, get the food, get the drink, and then enjoy myself, and then it's someone who's late comes in. So the thing is, volume's never going to help you because it's only showing you after the effect. And in most Forex, you're never going to be able to track the volume anyway. All volume shows you is what, again, has already happened. We want to think about what's going to happen before it happens. And as Robert asked me here, but in Forex, how to check the volume since the market's decentralized? There's the answer to that question. You can't. So it doesn't matter. In fact, the fact to understand is it's more the imbalance that's key. That's the thing, yeah? It's the imbalance that is the most important thing, guys. You understand? It doesn't matter if there are only 100 orders versus 30 orders. That's not a lot of volume, but if there's 100 buyers and 30 sellers, the price is still going to go up. Do you understand? Whether if there's 1 million sellers and 30,000 buyers. It doesn't matter. The numbers actually don't matter. The imbalance is what creates the price movement. A lot of people make the mistake of thinking that big green candles are high volume buys and big red candles are high volume sells. Sometimes massive moves happen in markets because of a lack of volume. Did you know that, guys? A lot of moves happen because of a lack of volume. So is this all making sense so far? Because, guys, this is the most important point about trading. And if we were to summarize this, okay, again, I'm all about logic at this. We're going to get into a pattern, and over the coming weeks, I want to start to show you how we can predict these turning points ahead of time. And what this is going to do, this is going to give us massive risk to reward potential. Huge. What about planning every trade ahead of time, knowing your entry, knowing your exit, knowing your risk? And when somebody says, well, what about news? I'll tell you this right now. Have you ever seen how fast prices sometimes rally and how quickly they drop on news, but they spike up really hard and then they basically collapse straight back down again very, very quickly? Have you ever thought about why that is? A lot of the time that's happening purely because there's a wall of buyers or a wall of sellers in the area. And as my very first mentor taught me, he said to me, Sam, don't worry about news. All news does is speed the price up and puts it on steroids. I don't care how fast you drive a car. When it hits a brick wall, it's going to stop. You understand, guys? And it's the same thing with price. So when we come down to, I want to leave you with this thing here, and then we'll go look at some charts just for 5 minutes or so, just to give you some levels that we can look at. And you can, and I'm going to show you how you can stay in contact with me. Okay, guys? I will give you my contact details at the end of this webinar as well, how you can reach out as well. And go over and show out, go to the website as well, because I want you to be able to see that. And I'll go over to our website and I'll show you obviously where you can also get a little bit more information if you're interested in kind of following a little bit more about what we do at the Academy, and also the best ways to stay in touch. So this, I think, is probably the best. This is a great example on here. Let me just go back over to my side. I think this really, to me, summarizes everything here. Okay, one more, perfect. One more, Sam. What's the reason for price not coming back to the zone after a huge move in the past? You know what I found? Another great question. It's just basically more demands coming. Maybe another institution has joined in. I've found that actually levels in the past that I've used, that I've had drawn on that didn't get hit, the price eventually comes back there. In fact, if sometimes I have a zone and it doesn't quite come down to that area, that makes me want the zone even more because I know that there's more demand building. It's just that maybe they front run it a little bit. And sometimes, the best laid plans don't work. So there'll be new demand zones created that we can join. Sometimes it's just that, you got to think, emotion comes in, sentiment comes in. I mean, look, people generally lose when they trade, uneducated people, but they have the odd wins, and maybe sometimes they got lucky and jumped in early. And also it just means that, at the end of the day, it's just not the right time. So if you miss a trade on a demand zone, hey, we're just going to look for the next supply zone or new demand zones as the trend forms. Just sometimes the demand is so great that the institutions will front run it. There's nothing you can do about that, buddy. It's just something that will happen. And when I'm always just like, I tell you this, after doing this for as long as I have, There's just some things you can't get around. You're just like, hey, that's just the way it is. It's just the way it goes, unfortunately. So you have to accept it and move on to a different currency pair. That's all it is. So I'm going to expand upon this more in our next webinar that we're going to do when we come back to our next session. But what I want to focus on really is here, and a couple of key takeaways. And I want you to be able to go away and take a little look at this, and then we can always follow up. First thing to think about this is when we're looking for areas of demand, we do not regard these as support areas, and we do not regard supply areas as resistance areas. The most important thing for me, a demand zone is specifically an area that's been created with a strong rally in price, or a supply zone, an area that's been created with a strong drop in price. That's the first thing, and I'm going to show you what that looks like on a price chart shortly. Secondly, who's on the other side of our trade? Is it a professional or is it a novice? The biggest mistake that most novice traders make is they buy after a rally in price at retail prices, or they sell after a drop in price at wholesale prices. And you see this constantly over and over and over again. And we'll go over to a chart, and let's take a little look on here and see, some of the key things. Like, for example, okay, let's just take a look at this one. The Euro GBP. I know this has been, I don't know if actually I've got some that we made over. This is a couple of trades actually, guys. I can show you that we've had on the dollar Canadian actually. These is all, like, I do a lot of longer term trading on this, but these are a couple of demand zones that we've had on here that have triggered in previous prices. Notice the strong drop in price that we had from the area on the dollar CAD here. Notice that we were in a downward trend for about, a week or so on this price, 2 weeks on this price. But notice what happened when we got to our area in yellow, where we saw this massive takeoff in price. That downward trend ended and we got a full-blown reversal in price, which went back to the opposing area. And look how strong the price was, or the drop away and the rally was from these two areas here. So just take a look at this for a second, guys. So notice on here when the price came out, look how strong that move away on the US dollar Canadian dollar price was. Look how strong that drop was away from there as well. Why get involved in the middle when we got the ability to get involved, guys, at the extremes? Now, if you actually look at the risk to reward ratio between these two areas as well, you got 1, 2, 3, 4, 5. So you got about 6, 7 to 1 risk to reward. Where a lot of people go wrong is they join the trend too late without looking to the left and seeing, well, what was the footprint? And this is like an elephant footprint, guys. Look at the takeoff in price we had here. I'd have been shocked if the price hadn't turned at this particular point. Likewise, then we engage in a rally. Now everyone's like, oh, well, I'm in an uptrend, I'm in an uptrend, I'm in an uptrend. You look to the left and it's like, yeah, but look what the institutions were doing here the last time price was here. What were they doing? Look at the drop in price. Price fell like a brick. Why? Because there was a lot of unfilled sell orders in this area. Okay, these are a couple of areas that I was using in my live session recently on my XLT, and I think you've got some of these you'll see on all of these. These are all pre-done areas where we have our trades. This was a recent one on the euro dollar that we were looking at on here. Great. Here's one I'm looking at coming up as it goes, guys. This was one obviously that we got recently, a nice level of supply, but this is an area I'm going to be keeping an eye on over the coming weeks here as well, guys. This area right here I'm going to be looking at. What we've got on here is a key area on here between 114.68 and 114.89. We're getting pretty high up on the euro dollar right now. Very strong exaggerated move away in price from this particular area. If the price comes back to this area of supply, I wouldn't be surprised to see some major selling pressure, because clearly institutions who were selling here were selling and didn't get all their orders filled. So we're expecting price to come back into this area and have a decent drop in price. Likewise, we're very rangy on the euro dollar right now. There's a lot of range bang price activity. So if I take this down and look to the left as well, I got a pretty strong evidence of price demand coming in. Another big institutional area here, which shows me there's a ton of unfilled buy orders in this area, where price rallied from 113.21 between 112.89. Now, we've got a decent enough risk to reward ratio between these two areas right now. People say, well, if the price comes back to this 13.21 area, what are you going to do, Sam? Well, I'd be a buyer, and I would have a stop loss on this market below this zone, because if it does go through the zone, I want to get out and I want to be done, right? I don't want to take an unnecessary risk. Likewise, if the price comes into my supply area and goes through this supply area, I'm going to take a small loss on it. But, I'd be very interested to see, especially this demand and this supply, how prices are going to basically react amongst these areas. Now, there's trade management. There are a series of things called odds enhancers that we like to look at as well. But this gives me a really good idea of where the best high probability, high opportunity, low risk trade ideas are going to be. Like right now, we've been seeing a ton of price activity, on the British pound. Okay, we've just seen, the pound, it's happened just recently, and not every level's going to work on here. But look, we had a level that got taken out here on the pound, but then we got to our next supply area that's being beautifully respected right now on the British pound. And what's interesting at the moment is the pound. You asked me about trend. The pound is starting to develop a little bit of a trend on here right now. So we've got a nice key area with a monstrous rally in price, where some evidence of really big institutional selling are. So if we do have another pullback in price to this particular area here, I wouldn't be too surprised between 28.99 and 28.29 to see a decent rally in price off of here. But right now, I can say, based on the demand that we've got and the overhead supply on here, if we can take out the current lows on the pound, of 130.54, I would not be surprised to see the price get down to about 129.09 in the next couple of days on the cable. And then I'd expect the buyers to come back in to take this back to the upside on here. Now, I'm just looking at long-term charts. Next time we can look at some short-term charts and go into, obviously, how we looked and find for these areas. But conceptually, guys, here, where these major turning points are, that's where institutional buying and selling is taking place. And guys, if you've got to start being aware of those, because there's no leading indicator that's going to get you ahead of the game other than those as well. Okay, so I'm at the top of my time on here. Let me just show you on here quickly how you can, if you've got any questions for me as well. I thought I'd just use this as a nice little introductory session. My colleague, Todd Davis, is actually going to be doing some premium webinars as well, going into even more detail. So this is kind of like a little teaser for you guys to give you a little bit of an idea of kind of what we do on here. Let me share this with you as well. This is how you can contact me, and I'm also going to type on here. Let me just type on here as well the website, so you know where you can get in touch with us as well. Let me just write that on there so you've got all of that information, okay, guys? I like to leave you with a little piece on this as well. I forgot to put the website on here, guys, so forgive me for that. There you go. The amateur investor. Yes, yeah, Todd and I teach the same. So if you like what I just went through there, Todd's premium webinar, his next premium webinar, I believe, is in a couple of weeks with FX Street. We'll be taking what we've just been doing in a little bit more detail as well. So I will be, Todd's going to be available on that one. I think they'll give you an email about that. A lovely little one from Peter Lynch here. The amateur investor has numerous built-in advantages if exploited to result in his or her outperforming the experts and also the markets in general. I love that little one. I'm always going to leave a little quote when I come from here as well. Guys, there's 3 ways to get, and I'm just going to get through your questions on here for just a second. My webinars, I'm going to be doing these at the moment on a monthly, okay, on a monthly basis. So I will be doing these on a monthly basis. My colleague Todd will be doing the premium one from OTA. So the pair of us are going to be doing 2 webinars a month. We might mix it up a little bit as well. Final question, when price is moving up in a trend, would it be dangerous to short supply levels? It would if you don't understand how to connect the time frames together. We'll talk a little bit more about that in our next webinar as well. So yes, be very cautious about that until you've got rules and a plan around defining your zones. Not all zones are built equal. So that's a great question on there, okay, Al, as well. But yes, Todd Michael will be following that strategy as well. I will be back up in doing another webinar next month. In the meantime, this is how you can keep in touch with me. I've got my email address is sam.evans@otahq.com. You can follow me on Twitter. I tweet a lot on there at Sam Evans Trader, and you can go to our website tradingacademy.com. And actually as well, yeah, OTA and King of Prussia, exactly. That's EP, exactly. Yeah, yes, you can. King of Prussia, absolutely. All right. So you can follow me on all of those things. Also, if you go on tradingacademy.com, my newsletter, Lessons from the Pros, is also on there. You can go on the archives. And if you like what I just talked about and want to expand a little bit more on that, please go to tradingacademy.com, search for Lessons from the Pros. In fact, let me quickly show it to you guys if you want me to show it to you. Here's our website. Okay. And if you actually go to tradingacademy.com, you go to Tools and you click on Lessons from the Pros. So I'll just show you this. So tradingacademy.com, you go to Tools and then you click on Lessons from the Pros. And then in here, if you actually take a look at the archives on the left-hand side, a lot of great free resources on here. If you take down, you can see on here previous articles by myself, Sam Evans, okay? And you can go back all the way back. Heck, I think you can go back on here to 2012 even, as far back. And look, I've probably got over 100 articles on here. Myths of fear and greed, patience, discipline. So if you like any of what I talked about here, any of my Sam Evans articles are on there as well for you guys to be able to follow as well. So you can check out any of them. They're all free to read and you can subscribe to that. And as I said to you before, a Twitter handle, if you want to follow me on Twitter and what I get up to on there, it's Sam Evans Trader on Twitter. You can follow me on there, and I like to I'll just show you this. I like to that's my Twitter page on there as well, where I like to put some information on there as well. So at Sam Evans Trader is the Twitter account on there, another place where you can stay in touch, and feel free to email me and we'll help out where we can. All right, guys, so I'll see you all next month as well, which is good, and I know this will be up on a recording. Thanks for your participation, guys. I wish you a lot of success, and I look forward to working with you all next month as well. All right, and thank you FX Street for giving myself an online trading academy the opportunity to spend a little bit of time with all of the class. So I really appreciate it. Have a great Wednesday. Be safe during FOMC day as well, guys. It can get a little choppy out there. All right, so just be careful. All right, and have a good one. All right, guys. Thank you so much, and take care. Thank you. Bye bye.